Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team and I welcome you all to another session of Commodity Catch-up where we'll discuss major market developments as well as price outlook for major non-agriculture commodities. It was a sell-off across commodities and once again the biggest contributing factor was the US dollar. Commodities weakened also on demand concerns amid mixed economic numbers and China's virus spread. A sharp correction in European gas prices also weighed on commodities. The general buy the US dollar and sell risky assets trend continued as the US dollar index jumped to fresh 2002 highs while equities and commodities remained under pressure. In commodities market, gold and silver fell, weighed down by firmness in US dollar and higher bond yields. Industrial metals slumped led by zinc amid easing supply concerns with correction in European gas prices and some improvement in power situation in China. Crude oil slumped as market players shifted focus from supply risk to demand concerns. The US dollar index ended higher for the third consecutive week and tested the highest level since 2002 as a number of Fed officials, including Fed Chairman Jerome Powell, reaffirmed that rate hikes may continue until inflation comes under control. Market players are now expecting a third consecutive 75 basis point rate hike in the month of September. The US dollar was unfazed by mixed US economic numbers and hawkish comments from ECB officials. A number of ECB officials have indicated the need to take aggressive measures to bring inflation under control. Rise in Eurozone inflation to a fresh record high level last month added to market talks of aggressive moves. The key US economic data last week was US non-farm payrolls report. US jobs report noted a 315,000 increase in US jobs last month after a 526,000 increase a month ago. However, the reading was slightly better than market expectation of a 300,000 increase. Meanwhile, US unemployment rate unexpectedly rose from 3.5% to 3.7%, while average hourly earnings rose less than expectation. US jobs report was mixed and highlighted increasing stress in the labor market. While the Fed may not change its stance owing to one economic reading, market players may continue to react to economic numbers and central bank comments. Mixed economic data from major economies highlighted increasing stress and dented demand expectation for commodities at large. Manufacturing PMI from Eurozone, China, UK remained below 50 level, indicating contraction in the sector, while US manufacturing data beat market expectation. Adding to demand concerns, Chinese authorities stepped up efforts in certain regions to limit the virus spread, hampering economic activity. European gas prices fell sharply last week, easing worries that production activity may be impacted due to power rationing. European gas prices corrected nearly 40% from recent March highs as European Union indicated that it may reach the stock target well before deadline. Adding to it, European Union leaders are working on ways to cap gas and power prices and reduce consumption, but no concrete measures have been announced so far. Supply concerns, however, remain high as Russia indicated that the supply on Nord Stream pipeline may not resume as planned after the 3-day maintenance. Adding to energy concerns, G7 finance ministers agreed to impose a price cap on Russian oil, a move that could impact crude supply. The sell-off in commodities has dented market sentiment, but we are set for volatile trade as market players look at various factors like central bank decisions, economic numbers, China's virus situation, as well as Russian energy supply. The key event for the coming week is ECB's monetary policy decision. After a 50 basis point rate hike in the month of July, market players are now debating between 50 basis point or 75 basis point rate hike at the upcoming meeting. Recent comments from ECB officials have fueled expectation of an aggressive move. If ECB takes an aggressive approach, it could result in some recovery in euro against the US dollar. Other key events include China's trade balance and inflation data and services PMI from major economies. It is a holiday shortened week as US markets are closed on Monday for Labor Day holiday. Let us now discuss individual commodities. Gold and silver ended lower last week, weighed down by firmness in the US dollar and higher bond yields amid Fed's monetary tightening expectation. ETF outflows also showed weaker investor interest. Global growth worries, inflation concerns, and geopolitical tensions, however, lent some support. With mixed factors in place and possibility of increased volatility in the US dollar post mixed US jobs report and upcoming ECB meeting, we suggest waiting for higher levels to create fresh shorts. Moving to industrial metals, base metals witnessed sharp selling last week, hurt by renewed lockdowns in China. Aluminium was weighed down further by easing supply concerns on news of resumed normal power supply for industrial and commercial usage in China's Sichuan province. Zinc tumbled the most in base metals, falling by more than 11%, weighed down by slump in European gas prices. Going ahead, industrial metals may remain under pressure as US Treasury Secretary reaffirmed that inflation remains at uncontrollably high levels, signaling that Fed may continue with tightening approach. Risk appetite may continue to be limited as softer US jobs report could not calm market sentiment about aggressive rate hikes. Also, uncertainty regarding China's COVID situation will weigh on metals, while Russia's indefinite suspension of Nord Stream gas pipeline may provide some cushion to zinc and aluminum prices. Lastly, in energy market, NYMEX crude corrected more than $10 from recent highs as mixed economic data and China's virus spread dented demand outlook. Sharp correction in European gas prices also dented expectation of higher fuel switching. Firmness in the US dollar and equity market sell-off also weighed on prices. However, supporting price was drop in US crude stocks, uncertainty about timing of Iran's nuclear deal, and supply risks relating to Russia. Crude may remain choppy as neither supply risks or demand concerns may get resolved anytime soon. However, with weaker risk sentiment and firmer US dollar, sell-on rises suggested. The key event for the coming week is OPEC Plus meeting. However, the group is not expected to make any major change in production policy. Lastly, natural gas fell sharply, weighed down by sharp correction in European gas prices, bigger than average rise in US gas stocks, and challenges to US LNG exports. Robust cooling demand, however, kept a floor to prices. Natural gas has slipped below the key $9 level, indicating bearish sentiment. However, we do not expect a sustained decline due to tightness in both US and global market. Well, that's it from my end. I wish you all a very happy trading week. Thank you.